Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jake Remley, Senior Portfolio Manager at Income Research and Management, to discuss how to be positioned in fixed income for 2023. Jake, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Thanks for having me.
You got it. And let's start with your thoughts on the macro, including inflation and depth and duration of a recession.
Sure. So inflation we see as getting better gradually, but it's been primarily in the goods sector. So there really is another leg to this that we haven't seen in the data yet, which is the wage growth piece, the rents, and the services-oriented industries showing signs of price pressure subsiding. But I do think we need to give it a little bit more time. We really haven't had the lag that the Fed has guided us towards, which is 6 to 9 months in the context of their biggest hikes, which were really late last summer. So from that perspective, the next 3 months should be pretty telling. On the recession side, we don't see it as our base case. We think the economy can handle 5% interest rates. However, the speed at which this tightening has taken place has made confidence pretty fragile, both on the business side and the consumer side. And from that standpoint, there's not much room for another exogenous shock, whether it be from politics with the debt ceiling or the conflict in Europe or in the economy as a whole, maybe from a certain segment really underperforming or some kind of real collapse of, say, the housing market or commercial real estate market. So from that standpoint, I think if things hold up and we continue to trend like we are, we'll be okay. But again, it's too soon to say that we're gonna miss it altogether here in the next couple of years.
Right. And Jake, let's switch from macro to fundamentals for a moment. What are your thoughts as it relates to earnings and the strength of the consumer?
Yeah, we're watching earnings closely. So it does look like they're going to be negative year over year for the fourth quarter. However, the general balance sheet strength is good. Leverage is in a good spot. Profit margins are still in a pretty good spot. They're getting some pressure from inflation, but not to any great degree yet. We just have to make sure that trend continues at the rate at which it's going. The consumer side of it also is similar story. So you do have this demand softening slightly, but consumers are also in a pretty good spot, liquidity-wise, equity-wise. They have shown and continue to show a willingness and an ability to make their mortgage payments, their auto payments, their credit card payments. So from that standpoint, we see it as okay right now. Again, incoming data is going to be extremely important here.
How constructive are you on fixed income for 2023?
We actually like it a lot. So we do think that 2023 is going to have the returns from fixed income are going to have a much higher component of income to them than 2022. So yields are much higher. Volatility is starting to come down. The Fed has signaled, and the dot plot suggests that they are near the end of their tightening. They may keep rates high for a while now, but we shouldn't see the same kind of pace of increases that we saw in 2022, which should allow buyers to come off the sidelines and demand to pick up again across the curve.
Right. So with that backdrop, how are you positioned across the fixed income asset class?
Yeah, so we really like the front end, especially if you want to stay defensive on duration and spreads. Specifically, the front end has some of the highest yields on the curve. We can't ignore the long end completely because the technicals from pension and foreign demand are so strong there that you really kind of have to maintain some positioning relative to, say, a full benchmark. The broad part of the curve, I think, is where we would say be careful because you're really not getting compensated as well, say, from the 5 to 10 year part of the maturity spectrum.
And finally, any areas that you would avoid in fixed income?
Yeah, the bond market's so vast and so nuanced. There's been a number of different corners of the market which have really benefited over the last 12 to 15 years from extremely good liquidity conditions, and that tide is going out now. So you're going to have a little bit higher premium on liquidity, a little bit more of a struggle to get deals done in smaller parts of the market and lower down in the credit spectrum. So from that standpoint, I think we're going to be staying kind of high quality, really in the more liquid parts of the market where we have confidence that we're fair value is a little bit more tangible, and that this volatility that will probably persist as quantitative tightening continues for the next couple of years is compensatory for the risk.
All right, Jake, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.